Network and Your Best 50. I'm your host, Jim Turpin. Thanks for joining us again today here at Radio Vision Network. And now that we're a day after tax day, what a great time to talk about exactly that, taxes. So many people get to tax day and say, boy, I wish I would have planned better for the year. So no better time to start looking at next year's taxes than right now. It's the day after filing day. Many people out there rush to the last minute. Roughly 40% of all tax returns filed occur within the last 14 days of the filing season. So you're out there with many of your brethren waiting and running around to the very last minute getting your tax returns in. The other issue that brings up, because of you're rushing so much, is that quite often you make a mistake. And so roughly 40% of all returns filled out by individuals, not by an accountant, not by a CPA, not by a trained tax professional, but 40% of all tax returns filled out by individuals have some sort of mistake in them. Whether they took too much of a deduction or too little of a deduction, either way that it worked out, it's still a mistake. So what a great time to really start planning for next year. And a couple things we want to talk about here as far as planning are concerned is that you really have to take into consideration your age. So here at Your Best 50, we really are focused towards the baby boomer generation, but I will give some of the younger audience a little bit of a little bit of information, and then mom and dad can kind of feed it back to them as well. So for the younger generation, especially those of you with kids, everybody with kids still gets the earned tax credit for your kids. It's a great thing. I have 4 of them. I love the fact that they're all under 18. And I'm getting that $12,000 a year in a credit for those kids. It's great. So make sure when if you have kids, you're taking advantage of that tax credit. So also for younger folks, what you need to focus on maybe not necessarily is tax deferral, but is really more of a tax plan. Now remember, everybody, I'm a financial advisor. I'm not an accountant. And I say that with purpose because I'm a true believer in that you let the professionals handle what their profession is. So while I know tax rules and tax strategies, I'm not an accountant or a CPA. I team with my clients' accountants and CPAs to come up with a proper strategy for them. It's much like the accountant, in my opinion, your accountant shouldn't be doing your financial planning either. He or she is an accountant. Their focus is on taxes. My focus is on putting together a plan for you, putting together the right investment strategy, picking out the right investments for you and your family today, tomorrow, and beyond. So that's why I say it's always important for you to have your financial team behind you, your accountant, your financial advisor, your attorney. Those are very key people. So this time of the year, your accountant, CPA, and your financial advisor really should be talking quite a bit. I can tell you in the last 3 weeks, I've probably spent 50% of my time on the phone with my clients' accountants and CPAs because we're coming up with, putting the touches on strategies from last year, making sure that any additional tax advantages can be taken care of, especially for my small business owners, and we'll talk about that in a little bit. But the real key at this time of the year is making sure that we took advantage of everything we could for the 2014 tax year, and now getting ready for the 2015 tax year. So quite often what I'm doing right now is putting together those plans with my CPAs and my accountants for my client base to say, hey, listen, we got caught short this year, or we had way too big a refund. Yes, I said you had too big a refund, and we'll talk about that as well. But the key here is that your professionals are putting that plan together, and we have the right strategy in place that meets your needs. People get confused on what's the best thing to do. They get frustrated with, what options I have. I can only put so much in my 401k. That's absolutely correct. But you can also, if you're still looking at the deferred side, we're also looking at, an IRA, depending on how much money you make, or a Roth IRA for those of you who can take advantage of it after tax dollars. And that's another key piece to this. Let's talk about taking advantage of your tax situation in the future. So especially for you baby boomers out there, many of you have done a great job of saving for retirement. You've put a lot of money into your 401k, your 403b, your KEO, your SEP if you're a small independent business owner. However, what you've also done is put together a potential tax landmine for yourselves in the future. I'll give you an example. I have a couple who were very good earners throughout their career. They saved a 7-digit number for retirement. And now they're looking at their first full year in retirement, and it's something I warned them about. They're going to pay just as much in taxes their first year in full retirement as they did their last couple years of employment. So now I'm paying the same amount in taxes. However, I have no income coming in. I'm living off my savings. I'm living off my retirement plan. So now I have this extra expense every year called taxes when I really should be having a smaller tax bill, but the problem is they saved too much in what I consider the wrong way. Not that they saved, but the fact that how they saved. Everything was tax deferred. You have to look at having some income put aside for your retirement that is what we call non-qualified money. So whether that money is put into a Roth, is put into mutual funds, and you're buying mutual funds every couple of weeks on a what we call a dollar cost average situation, or you're using a life insurance policy, a permanent life insurance policy to buy protection now, but in the future have the ability to take income out tax-free. These are all things that people have to look at and measure to see if that's the right thing for them. And it's a balancing act, and that's the key. It's like a good, I always say it's like a good diet. If I'm having too much carbs and I'm having too much sugar, then I'm going to get fat and I'm going to have a problem. If I have a good balanced diet of, whole grains, proteins, the right amount of carbs, very little sugar, low fat, then I'm not going to have problems in the future. I'm going to kind of sail through my retirement years with little or no problem. But it all comes into planning, and that is the key, ladies and gentlemen. You have to put a plan together. So on the other side, what we're going to talk about is putting that plan together for both the younger groups and my baby boomers. Don't forget, it's not too late for you baby boomers to make some good adjustments in your tax strategy and your saving strategy for the future in order to come out on the other side and make sure you have a much lower tax burden in retirement than you do while you're working. So we'll be right back with your best 50 in just a minute.
Here, we have an attractive orange and a distinguished apple. The two similar, but opposites. Theory, a wingman is needed, or perhaps a wing lemon. A friend to the orange and an acquaintance to the apple, the lemon brings the two opposites together. See, with a little fresh thinking, the universe can be surprisingly smooth.
When we make Beyond Natural dry dog and cat foods, we start with real meat as the first ingredient. We leave out corn, wheat, and soy. And we own where our dry food is made. 100%. Can other brands say all that? For nutrition you can trust and your pet will enjoy. Does your food go beyond? Learn more at purinabeyond.com.
Fitzpatrick's. Deli Dine for breakfast and lunch. And at night, Gourmet Dine for dinner with entrees and specialty sandwiches including certified black Angus cuts of beef and wild-caught seafood, plus catering options for specialty events. Since 1989, Fitzpatrick's, your hometown place with upscale tastes.
Welcome back to Radio Vision Network and Your Best 50. I'm your host, Jim Turpin. So just before the break, we were talking about putting that tax strategy together for next year and also making some adjustments for the future. So let's talk about next year. So for my younger viewers, or for this to get pushed on to the kids from mom and dad, take a look at what your company matches in your 401k. Many companies out there will match your 401k up to maybe 5%. So if your company is matching 5%, you want to put in at least 5% into your 401k. It's free money. So why shouldn't you take advantage of that? I have people say to me, well, why aren't I maxing out? Why aren't I putting in my full 16%? Well, that's great. If you want to put in your full 16% and get the 5% match, that's perfect. But that's probably all the money you can save. So now I'm saving my 16% every year, which is great. Don't get me wrong. However, that is all tax deferred. So now if I'm 30 years old and I work till I'm 65 and I'm putting away 16% of my income every year on a tax deferred basis, when I get out at 65, I almost will guarantee you that my tax rate at 65 is going to be at or above what I'm paying today as I'm working. That is a true problem. You have to have a balance. This is, what I would call the, kind of the South Beach diet, where I'm all in on just one thing and I have no balance. Really what we need is more balance here. So what I always suggest to people, we'll use the 5% example. I put my 5% in, it's matched by my company at 5%, and then the rest of that money that I would have been putting away every 2 weeks, I'm taking that money out and I'm paying myself first. I always believe that I have to pay myself first because I'm the most important person out there, and no one else is going to take care of me except for me. So if I then take that other, say, 11% that I was trying to save in post-tax dollars, and I'm now putting that money into a good mutual fund strategy, maybe some stocks, potentially into a life insurance policy that is going to provide me protection today. Remember, you've heard me say this probably 100 times over the last few years. If someone's trying to sell you life insurance as an investment, run the other way. Life insurance is for protection first. I buy life insurance to protect my family. It might have a long-term care rider on it, again, to protect my family. But then if I don't need it for protection any longer down the road, 20, 30, 35 years from now, I can turn it on as an income stream. And that income stream is tax-free. So these are all the things that you have to really consider when it comes for the younger folks putting that plan together. Now, let's talk about our baby boomer generation, right? So once you're over 50, if you were a little bit slow on the uptake for your 401k and you feel you haven't put enough money away, you can put an extra $5,000 away every year until you retire. So it's what we call a catch-up. So if you need to take advantage of that, great. If tax deferral is the right call for you. Again, people don't think about it. They go, I want to put that money away and not pay taxes on it. Well, that might be good today, but that may be just kicking the can down the road and creating a problem for yourself later on. So one of the things I always tell my older folks, especially if they're within 10 years of retirement, take a look. Get with your financial advisor. If you don't have someone, give me a call. Sit down with someone who's going to talk about it with you for free. Make sure you're not getting charged for, somebody's opinion that you may not like or you may not trust. So make sure that you're getting an educated opinion about this from a good professional and come up with what your projected tax strategy is. Any good advisor is going to be able to give you that sort of advice and give you that sort of forecast. Now, I don't have a crystal ball, and I don't know what taxes are going to look like 10 years from now. So, and neither do the accountants, and neither does anybody else. The politicians don't either. So what we do is a good advisor will give you a projection based on some different types of tax rates and some different types of inflation rates, and potentially what your Medicare expense might look like, what your Social Security income might look like, and how that might get taxed down the road. Yes, don't forget, if you make too much money in retirement, even at full retirement age, your Social Security then becomes taxable. So it's really important that you understand how how everything fits together in your puzzle called retirement. And again, you've heard me say this too a bunch of times. Look, they write hundreds of books on how to save for retirement, but they don't teach you how to spend it. And the other thing they don't teach you in those books on how to save for retirement is they don't talk about the taxes. And that is so key when it comes to, having a good strategy together for the future and not just looking at today. So my older clients get that plan together. Now, one of the things that you have to look at is if today you had a big return coming in. So if you had more than a $2,000 return come in, I think that's a bit of a problem. And again, that is my opinion. Why are you giving the government your money to borrow interest-free? So you wouldn't loan the money out if you were a bank interest-free. Well, you're certainly not a bank, so why are you lending it to the government? I think the good rule of thumb, and the accountants and CPAs that I tend to work with agree with me, is that if we're within $2,000 of paying or getting back, you've done a good job of tax planning. Anything greater on either side really, in my opinion, should be looked at. I don't want to have a big bill at the end of the year where I'm looking at it and going, how am I going to pay for that? Filing an extension, paying penalties and interest on monies that I owe. And I don't want to get that same huge number back either, because it's money I could have used during the year. It might have hurt my cash flow. It might have had, there might have been some needs during the year where, you could have used an extra $500 or $600, but there's $7,000 or $8,000 coming back in a tax return now, and it's not there to be used. Now, I always hear the argument, well, I just take that money and I put it in a savings account and I, use it during the year. Great. But still, wouldn't you rather have that money in your pocket today and not wait until, sometime in April to get the money back? So that's always my advice to people, is that, what you really should be doing is having that good balance and making sure that you have a plan that you can live with today and in the future. Remember, one of the worst things that you can do is be investment poor, or in this case, be tax poor. One of the things as part of that plan is we want to make sure that you can afford whatever you're doing. So whether it's, putting that 5% into your 401k to make your match, or it's taking that extra money and dollar cost averaging into mutual funds, or putting it in a Roth, or investing in protection for your family in an index life insurance policy, whatever it might be, you need to make sure it all fits into your budget. Now remember, you have to pay yourself first. One of the things that you want to do is make sure that everything works out, and at the end of the month, you're good to go. All right, so we're going to pause for a moment, and when we get back, we're going to wrap up, and we're going to talk to the boomers about the things that you should start to think about for next year on the things that you might have missed out on this year. We'll be right back on Radio Vision Network.
Here, we have an attractive orange and a distinguished apple. The two similar, but opposites. Theory, a wingman is needed. Or perhaps a wing lemon. A friend to the orange and an acquaintance to the apple, the lemon brings the two opposites together. See, with a little fresh thinking, the universe can be surprisingly smooth.
When we make Beyond Natural dry dog and cat foods, we start with real meat as the first ingredient. We leave out corn, wheat, and soy. And we own where our dry food is made. 100%. Can other brands say all that? For nutrition you can trust and your pet will enjoy, Does your food go beyond? Learn more at purinabeyond.com.
Fitzpatrick's. Deli dine for breakfast and lunch. And at night, gourmet dine for dinner with entrees and specialty sandwiches including certified black Angus cuts of beef and wild-caught seafood, plus catering options for specialty events. Since 1989, Fitzpatrick's, your hometown place with upscale tastes.
Apple Ridge is about freedom. Apple Ridge is about community. Apple Ridge is about home. Apple Ridge, everything you want, more than you expect. Welcome to your new neighborhood. Apple Ridge Senior
Welcome
Living.
back to Radio Vision Network and Your Best 50. I'm Jim Turpin. So our last segment today is going to talk about what to do for 2015. So boomers, listen up. One of the key things for you is to make sure that you are in good shape for the future. So I'll break that down into two pieces. Those of you who are within 10 years of retirement should have a tax plan now that's going to work for you over the next 2 or 3 years. And make sure it's adjusted every couple of years based on your income. So especially for my boomers who are making a lot of money, if you're making a lot of money now, take advantage of the low tax rates today. Remember, we're at some, and I know even if you think you're paying a lot in taxes, and I know you are, you're still not paying as much in taxes as you were 20 years ago. So we're at our lowest rate in almost 80 years. Take advantage of the low tax rates now. Invest after taxes as much as possible. Take a look at that. Take a look at your balance and make sure that you're in good shape, especially over the next 2 or 3 years. We have an election coming up soon. Don't fool yourselves. If you don't think the next election is going to have a big impact on your retirement, especially if you're going to retire in the next 10 years, you're crazy. And without getting into particulars, if we have another Democrat and we still have a split Congress, you could really see, a big war go on over what's going to happen with taxes. If you have a Republican in there with a Republican House and Senate, you're probably going to see some pretty sweeping changes, and that's going to put you in a better position down the road. So that's real key that the plan right now, if you're within the next 10 years of retirement, that over the next 2 or 3 years, that plan is in place and we're ready to adjust it when needed. If you're within 5 years of retirement, that's a little bit of a different story. I really want you, even if you're a big earner, I really want you focused on putting away as much post-tax income as possible. Again, lowest tax rate in years. Take advantage of that now. Put the money where it can go to work for you. Now, if you are within that 5 years of retirement, there are different things that you need to be looking at. You might want to be weighted a little bit less in the stock market. Or if you're in the market unprotected, then really what you want to do is make sure that you're in, one of my favorites is dividend paying stocks. But they're not right for everybody. You really have to take it on a case-by-case basis. The other thing is you have to take a good hard look at your mutual fund portfolio. It's really key to understand, especially if you're in that 5-year window, what your mutual funds mean to you from a tax perspective. So if you have mutual funds that aren't very tax friendly and you're getting hit with big dividend expenses every year or taxes and capital gains, then you may want to look at what your true return is on those, right? So that account or that mutual fund may have been up 12% this year, but it cost you 6% in taxes. So you really only netted out 6%. So you need to take a good hard look and say, hey, is that the right fund for me given my tax scenario? And is that going to be the right fund for me? If it is today, is it going to be the right fund for me in the future? So that's very important as well. The other thing that people should start to look at, and again, they're not right for everyone, but should start looking at any type of annuity. preferably, and if you're still working, I tend to favor a fixed indexed annuity where the principal is protected, and you might have a little bit lower growth, but you also have a protection of principal. You're going to get a much better interest rate, much better return than a CD would. Plus, all the growth is tax deferred, so I can use after-tax money, make an investment, not pay any taxes on the growth until I start to use the money. Again, not for everybody, but it's something that everyone should look at and see, hey, does this make sense for me? It'll also protect you against all the downside of the market as you're getting closer to your retirement years. Now, the other thing is Social Security. I've talked many times on the show about Social Security, but make sure your numbers are good. Check your Social Security and understand how much you're going to be making in Social Security. Make sure you know what your projections are as far as income is concerned, because that's also going to have an impact on your taxes. Now, if you're going out early, if you're going to retire at 62, and you're going to start taking Social Security at 62, and you're going to start to pull on your retirement account, don't forget there's a bigger penalty for you between the years of 62 and 66, or 65, depending on what your full retirement age is. So just make sure that you understand, what it means to retire early, the impact on taxes, and how that's all going to work for you. Okay? So if you have any more questions about your taxes or putting together a good tax strategy and you haven't talked to your accountant or CPA about it for 2015, I suggest you get in front of them now and get that plan together, or get in front of your financial advisor, someone like myself, who's going to help you start to put that plan together, do an analysis on everything while it's still fresh in everybody's mind, and start to get that plan together for 15 and beyond. So I want to thank everyone again for joining us this week on Your Best 50. I'm your host, Jim Turpin, and if you'd like to get in contact with me, you can email the show at yourbest50@gmail.com. You can email me at jimturpin@oneapg.com, or you can reach me in my office at 856-685-7825. Thanks for tuning in this week, and have a great day.